Events after the reporting date. Ind AS 10. Events after reporting date are those events which are favorable or unfavorable and which occurs between the reporting date and the date when financial statements are approved for issue by the board of directors. If financial statements are to be approved by shareholders after financial statements are approved by board of directors, financial statements are approved for issue on the date of approval by board of directors. If financial statements are to be issued by a supervisory board of non-executive directors for approval after management approves financial statements are considered as approved for issue when management or board of directors approve financial statements. If financial statements are approved by board of directors after public announcement of profit or other financial information, financial statements are approved for issue on date of approval by board of directors. Now, events, types of events, adjusting event and non-adjusting event. Adjusting event is which provides evidence of condition existing on reporting date. It is adjusted to the financial statements. Non-adjusting events are which relates to a condition arising after the reporting date. No adjustment is required. Disclosure of such event is required in financial statements, that is, notes to accounts if the amount is material. Examples of adjusting event: the settlement of a court case after the reporting period, the bankruptcy of a customer that occurs after the reporting period, the sale of inventories after the reporting period may give evidence about their net realizable value at the end of the reporting period. The determination after the reporting period of the amount of profit sharing or bonus payments. The discovery of fraud or errors that show that the financial statements are incorrect. Examples of non-adjusting event: decline in market value of investments, major business combination, announcement of plan to discontinue an operation, major purchase of an asset, classification of non-current asset as held for sale after reporting date, change in forex rate, major litigation after reporting date. Certain special cases: long-term loan, NCL. Whenever there is a breach of material provision in case of a long-term borrowing on or before reporting date, with the effect that such loan becomes payable on demand, which means it becomes a current liability. Such loan shall be classified as non-current liability if lender agrees not to demand payment before approval of financial statement for issue. So, breach of contract of long-term borrowing on or before reporting date. If it is a minor default, it stays as a non-current liability. If it is a major default and the lender agrees not to demand payment before approval of accounts, then it is still stays as non-current liability. All other cases, this long-term borrowing shall be classified as current liability. As per IAS 10, events after the reporting period, rectification of any breach after the end of the reporting period is a non-adjusting event, though material or not. Going concern. An entity shall not prepare financial statements as per going concern if it intends to liquidate or cease trading or has no realistic alternative but to liquidate. If going concern assumption is not appropriate, that is, it becomes invalid after the reporting date, Ind AS 10 requires a fundamental change in the basis of accounting rather than adjustment to financial statements. Ind AS 1 requires the following disclosures if financial statements are not prepared on going concern: facts, basis of preparing financial statements, reason why entity is not regarded as going concern. Now, if there is an event after the reporting date and the going concern remains valid, it is a non-adjusting event. Disclosure is required if the amount is material. If the going concern is not valid, it becomes an adjusting event. There shall be a fundamental change in the basis of accounting. Disclosure is required as per Ind AS 1. Proposed dividend. If an entity declares dividend to holders of equity instruments after reporting date, The entity shall not recognize it as liability at the end of the reporting period. However, such dividends are disclosed in notes in accordance with Ind AS 1 and requirement of Schedule 3, disclosure requirement. The date of approval of financial statement for issue. Who gave the approval? Entity's owner or others who has the power to amend financial statements after the issue. Updating disclosure about conditions existing on reporting date for adjusting event. Non-adjusting event if material following disclosures are required. Nature of event, estimate of financial effect. If the financial effect cannot be estimated, the facts must be disclosed. Difference between Ind AS 10 and Ind AS 4. Ind AS 10 and AS4. Ind AS 10 is about disclosure in financial statements. AS4 is disclosure in report of approving authority. Going concern. Ind AS 10 requires fundamental changes in the basis of accounting if going concern becomes invalid. Ind AS 1 also requires additional disclosure. AS4 requires adjustments to assets and liabilities. Distribution of non-cash asset to owner, holder of equity instrument, as per Appendix A to the Ind AS 10. Non-applicability of Appendix A to Ind AS 10. It is not applicable for accounting in the books of shareholders who receive such distribution. It is not applicable to distribution of non-cash asset to entity which is ultimately controlled by the same party before and after distribution. Applicability. It applies to the following types of non-reciprocal transactions between entity and owner. Distribution of non-cash asset. Distribution that gives owner an option of non-cash asset or cash alternative. Accounting treatment. On the date of proposal or announcement of such distribution, there is no entry. On the date of declaration and approval of such dividend, retained earnings will be debited to dividend payable with the fair value of non-cash assets held for distribution. On the reporting date before distribution, dividend payable will be reassessed with any changes in the fair value of non-cash assets held for distribution. On the date of distribution, dividend payable debited to non-cash assets. Any difference will be recognized in the profit or loss as gain or loss on distribution. For example, entity proposes a distribution of 1 pen to all shareholders on 15/1/2017. Entity declared and approved the dividend for distribution of 1 pen to all shareholders on 15/2/2017. It was actually distributed on AGM which was held on 15/5/2017. Fair value of each pen on 15/1/2017 is 500. 15/2/2017 will be 500. 31/3/2017 will be 520. 15/5/2017 will be 515. Cost price of each pen is 400. Number of shareholders is 1000. So in 16/17, as on 15/2/2017, the following entry: retained earning account debited 5 lakh to dividend payable. 5 lakh being 1000 multiplied by 500. 500 is the fair value as on 15/2/2017. On 31/3/2017, retained earning debited 20,000 to dividend payable. As the difference in fair value, 500 became 520. So 520 minus 500, 20 multiplied by 1000, 20,000 rupees debited again to retained earnings. In 15/5/2017, dividend payable account debited 5,000. This is reversal due to decrease in fair value. 520 became 515. 15/5/2017, the fair value of the pen is 515. Hence 520 minus 515 multiplied by 1000, which is 5,000 rupees. Finally, while the dividend was paid in the form of pen, dividend payable account debited 5,15,000 to inventory 4 lakh, to profit or loss 1,15,000. Questions. What is the date of approval for issue of financial statements prepared for the reporting period from April 1, 2011 to March 31st, 2012? in a situation where the following dates are available. Completion of preparation of financial statements is May 28, 2012. Board reviews and approves it for issue in June 19, 2012. Available to shareholders on July 1st, 2012. Annual general meeting held in September 15, 2012. Filed with regulatory authority in October 16th, 2012. Will your answer differ if the entity is a partnership firm? As per Ind AS 10, the date of approval for issue of financial statements is the date on which the financial statements are approved by the board of directors in case of a company, and by the corresponding approving authority in case of any other entity. Accordingly, in the instant case, the date of approval is the date on which financial statements are approved by the board of directors of the company, which is June 19th, 2012. In the case of an entity, if the entity is a partnership firm, the date of approval will be the date when the relevant approving authority of such entity approves the financial statement for issue. That is the date when the partners of the firm approves the financial statements. Next, ABC Limited prepared interim financial report for the quarter ended June 30th, 2011. The interim financial report was approved for issue by the board of directors on July 15, 2011. Whether events occurring between end of the interim financial report and date of approval of board of directors, that is events between July 1, 2011 and July 15, 2011, that provide evidence of conditions that existed at the end of the interim reporting period, shall be adjusted in the interim financial report ending June 30th, 2011. Paragraph 3 of Ind AS 10 inter alia defines events after the reporting period as those events, favorable and unfavorable, that occur between the end of the reporting period and the date when the financial statements are approved by board of directors in case of a company, and by the corresponding approving authority in case of any other entity for issue. What is reporting period has not been dealt with in Ind AS 10. Absence of any specific guidance regarding reporting period implies that any term for which reporting is done by preparing financial statements is the reporting period for the purpose of Ind AS 10. Accordingly, financial statements financial reporting done for interim period by preparing either complete set of financial statements or by preparing condensed financial statements will be treated as reporting period for the purpose of Ind AS 10. Paragraph 2 of Ind AS 34 inter alia provides that each financial report, annual or interim, is evaluated on its own for conformity with Ind AS. Further, paragraph 19 of Ind AS 34 provides that an interim financial report shall not be described as complying with Ind AS unless it complies with all the requirements of Ind AS. In accordance with the above, an entity describing that its interim financial report is in compliance with Ind AS has to comply with all Ind AS, including Ind AS 10. In order to comply with the requirements of Ind AS 10, each interim financial report should be adjusted for the adjusting events occurring between the end of the interim financial report and the date of approval by the board of directors. Therefore, in the instant case, events occurring between July 1, 2011 and July 15, 2011 that provides evidence of conditions that existed at the end of interim reporting period should be adjusted in the interim financial report ending June 30th, 2011. The board of directors of ABC Limited approved the financial statements for the reporting period 2011-12 for issue on June 15, 2012. The management of ABC Limited discovered a major fraud and decided to reopen its books of accounts. The financial statements were subsequently approved by the board of directors in June 30th, 2011. What is the date of approval for issue as per Ind AS 10 in the given case? Date of approval is the date on which financial statements are approved by the board of directors in case of a company and by corresponding approving authority in case of any other entity for issue. In the given case, there are two dates of approval by the board of directors. The financial statements were reopened for further adjustments subsequent to initial approval. The date of approval should be taken as the date on which financial statements finally approved by the board of directors. Therefore, in the given case, the date of approval for issue as per Ind AS 10 should be considered as June 30th, 2012. Next, a case is going on between ABC Limited and GST Department on claiming some exemption for the year 2001-2002. The court has issued the order in 15 April 2002 and rejected the claim of the company. Accordingly, the company is liable to pay additional tax. The financial statements of the company for the year 2001-2002 have been approved on 15th May 2002. Should the company account for such tax in the year 2001-2002, or should it account for the same in the year 2002-2003? An event after the reporting period is an adjusting event if it provides evidence of a condition existing at the end of the reporting period. Here, this condition is satisfied. Court order received after the reporting period provides evidence of the liability existing at the end of the reporting period. Therefore, the event will be considered as an adjusting event, and accordingly the amounts will be adjusted in the financial statements for 2001-2002. Next. While preparing its financial statements for the year ended 31st March 2011, XYZ Limited made a general provision for bad debts at 5% of its debtors. In the last week of February 2011, a debtor for 2 lakhs had suffered heavy loss due to an earthquake. The loss was not covered by an insurance policy. Considered Considering the event of an earthquake, XYZ Limited made a provision of 50% of the amount receivable from that debtor apart from the general provision of 5% on remaining debtors. In April 2011, the debtor became bankrupt. Can XYZ Limited provide for the full loss arising out of insolvency of the debtor in the financial statements for the year ended 31st March 2011? Would the answer be different if the earthquake had taken place after 31st March 2011 and therefore XYZ Limited did not make any specific provision in context debtor debtor and made only general provision of bad debts at 5% on total debtors? As per the definition, events after the reporting period and paragraph 8 of Ind AS 10, events after the reporting period financial statements should be adjusted for the events occurring after the reporting period that provides evidence of conditions that existed at the end of the reporting period. In the instant case, the earthquake took place before the end of the reporting period, that is in February 2011. Therefore, the condition exists at the end of the reporting date, though the debtor is declared insolvent after the reporting period. Accordingly, full provision of the bad debt amounting to 2 lakh should be made to cover the loss arising due to the bankruptcy of the debtor in the financial statements for the year ended 31st March 2011. Since the provision for bad debts on account of amount due from that particular debtor was made 50%, XYZ Limited should provide for the remaining amount as a consequence of declaration of this debtor as bankrupt. In case the earthquake had taken place after the end of the reporting period, that is after 31st March 2011, and XYZ Limited had not made any specific provision for the debtor who was declared bankrupt later on, since the earthquake occurred after the end of the reporting period, no condition existed at the end of the reporting period. The company had made only general provision for the bad debts in ordinary business course and not to recognize the catastrophic situation of an earthquake. Accordingly, bankruptcy of the debtor in this case is a non-adjusting event as per para 21 of Ind AS 10. If non-adjusting events after the reporting period are material, non-disclosure could influence the economic decisions that users make on the basis of the financial statements. Accordingly, an entity shall disclose the following for each material category of non-adjusting event after the reporting period: the nature of the event and an estimate of its financial effect, or a statement that such an estimate cannot be made. If the amount of the bad debt is considered to be material, the nature of this non-adjusting event, that is, event of bankruptcy of the debtor, should be disclosed along with the estimated financial effect of the same in the financial statements. Next, a company has inventory of 100 finished cars on 31st March 2002, which are having a cost of 4 lakh each. On 30th April 2002, as per the new government rules, higher road tax and penalties are to be paid by the buyers for such cars, which were already expected to come. And hence, the selling price of the car has come down and the demand for such cars have dropped drastically. The selling price has come down to 3 lakh each. The financial statements of the company for the year 2001-2002 are not yet approved. Should the company value its stock at 4 lakh each or should it value at 3 lakh each? Ignore the estimated cost necessary to make the sale. Events after the reporting period provide evidence about the net realizable value of the cars at the end of the reporting period, and therefore the amount of 3 lakh should be considered for the valuation of stock. Next, ABC Limited has purchased a new machinery during the year 2001-2002. The asset was finally installed and made ready for use in 15th March 2002. However, the company involved in installation and training, which was also the supplier, has not yet submitted the final bills for the same. The supplier company sent bills on 10th April 2002 when the financial statements were not yet approved. Should the company adjust the amount of capitalization in the year 2001-2002 or the year 2002-2003? As per the provisions of the contract, the cost of installation and training of new machine is an integral part of the cost of asset purchased. Therefore, even if the details are available after the reporting period, they provide proof about the circumstances that existed at the end of the reporting period. Therefore, the cost of installation and training will be considered for capitalization in the year 2001-2002. Next, Company XYZ Limited was formed to secure the tenders floated by a telecom company for publication of telephone directories. It backed the tender for publishing directories for Pune Circle for 5 years. It has made a profit in 2011, 2012, 2012, 2013, 2013, 2014, and 2014, 2015. It bid in tenders for publication of directories for other circles, Nagpur, Nashik, Mumbai, Hyderabad. But as per the results declared on 23rd April 2015, the company failed to bag any of these. Its only activity till date is publication of Pune directory. The contract for publication of directories for Pune will expire on 31st December 2015. The financial statements for financial year 2014-15 have been approved by the Board of Directors on July 10, 2015. Whether it is appropriate to prepare financial statements on going concern basis. With regard to going concern basis to be followed for preparation of financial statements, whereas 14 and 15 of Ind AS 10 states that an entity shall not prepare its financial statements on a going concern basis if management determines after the reporting period either that it intends to liquidate the entity or to cease trading or that it has no realistic alternative but to do so. Deterioration in operating results and financial position after the reporting period may indicate a need to consider whether the, the going concern assumption is still appropriate. If the going concern assumption is no longer appropriate, the effect is so pervasive that the standard requires a fundamental change in the basis of accounting rather than an adjustment to the amounts recognized within the original basis of accounting. In accordance with the above, an entity needs to change the basis of accounting if the effect of deterioration in operating results and financial position is so pervasive that the management determines after the reporting period either that it intends to liquidate the entity or to cease trading or that it has no realistic alternative but to do so. In the instant case, since contract is expiring on 31st December 2015, and it is confirmed on the 23rd April 2015, that is after the end of the reporting period and before the approval of the financial statements, that no further contract is secured, implies that the entity's operations are expected to come to an end. Accordingly, if entities' operations are expected to come to an end, The entity needs to make a judgment as to whether it has any realistic possibility to continue or not. In case the entity determines that it has no realistic alternative of continuing the business, preparation of financial statements for 2014-15 and thereafter on going concern basis may not be appropriate. In the plant of PQR Limited, there was a fire on 10/5/2011 in which the entire plant was damaged and the loss of 40 lakh is estimated. The claim with the insurance company has been filed and a recovery of 27 lakh is expected. The financial statements for the year ended 31/3/2011 were approved by the Board of Directors on 12th June 2011. Show how should it be disclosed. In the instant case, since fire took place after the end of the reporting period, it is a non-adjusting event. However, in accordance with para 21 of Ind AS 10, disclosures regarding non-adjusting event should be made in the financial statements. That is, the nature of event and the expected financial effect of the same. With regard to going concern basis, followed for preparation of financial statements, the company needs to determine whether it is appropriate to prepare the financial statements on going concern basis. Since there is only one plant which has been damaged due to fire, if the effect of the deterioration in operating results and financial position is so pervasive that management determines after the reporting period either that it intends to liquidate the entity or to cease trading or that it has no realistic alternative but to do so. Preparation of financial statements for financial year 2010-2011 on going concern assumption may not be appropriate. In that case, financial statements may have to be prepared on the basis other than going concern. However, if the going concern assumption is considered to be appropriate even after the fire, no adjustment is required in the financial statements for the year ended 31/3/2011. ABC Limited declares the dividend on 15th July 2002 as the results of the year 2001-2002 as well as Q1 ending 30th June 2002 are better than expected. The financial statements of the company are approved on 20th July 2002 for the financial year ending 31st March 2002. Will the dividend be accounted for the financial year 2002-2003 or will it be accounted for the year 2001-2002? The dividend is declared in the year 2002-2003. Therefore, the obligation toward dividend did not exist at the end of the end date of reporting period, that is on 31st March 2002. Therefore, it will be accounted for in the year 2002-2003 and not in 2001-2002. Even if financial statements for 2001-2002 were approved after the declaration of dividend. It will, however, be disclosed in the notes in the financial statements for the year 2001-2002 in accordance with Ind AS 1. Next, what would be the treatment for dividends declared to redeemable preference shareholders after the reporting period but before the financial statements are approved for issue of issue for the year 2011-2012? Whether Ind AS 10 prescribes any accounting treatment for such dividends. Paragraph 12 of Ind AS 10 prescribes accounting treatment for dividends declared to holders of equity instruments. If an entity declares dividends to the holders of equity instruments as defined in Ind AS 32 financial instruments presentations, after the reporting period, the entity shall not recognize those dividends as a liability at the end of the reporting period. However, Ind AS 10 does not prescribe accounting treatment for dividends declared to redeemable preference shareholders. As per the principles of Ind AS 32 financial instruments presentation, a preference share that provides for mandatory redemption by the issuer for a fixed or determinable amount at a fixed determinable future date or gives the holder the right to require the issuer to redeem the instrument at or after a particular date for a fixed or determinable amount is a financial liability. Thus, dividend payments to such preference shares are recognized as expense in the same way as interest on a bond. Since interest will be charged on time basis, the requirements of Ind AS 10 regarding date of declaration of dividend not relevant for its recognition. Next, AGM of ABC Limited for the year ended 31st March 2002 was held on 10th July 2002 and board meeting has been conducted on 15th May 2002. Meanwhile, the company had to disclose certain financial information pertaining to the year ended 31st March 2002 to SEBI as per SEBI regulations on 20th April 2002. Since certain financial information pertaining to the year ended 31st March 2002 is submitted to SEBI before approval of financial statements by the board, the management is suggesting that 20th April 2002 shall be considered as after the reporting period. Whether the management's view is correct in accordance with the guidance given in Ind AS 10. As per Ind AS 10, even if partial information had been published, the reporting period will be considered as a period between the end of the reporting period and the date of approval of financial statements. In the above case, the financial statements for the year 2001-2002 were approved on 15th May 2002. Therefore, the purpose of Ind AS 10 after the reporting period would be the period between 31st March 2002 and 15th May 2002. A Limited was required to pay penalty for a breach in performance of a contract. A Limited believes that the penalty was payable at a lower amount than the amount demanded by the other party. A Limited created a provision for the penalty but also approached the arbitrator with the submission that the case may be dismissed with costs. A Limited prepared the financial statements for the year 2011-2012, which were approved in July 2012. The arbitrator in June 2012 awarded the case in favor of A Limited. As a result of the award of the arbitrator, the provision earlier made by A Limited was required to be reduced. The arbitrator also decided that the cost of the case should be borne by the other party. Now, whether A Limited is required to remeasure its provision and what would be the accounting treatment of the cost that will be recovered by A Limited, which has already been charged to the statement of profit and loss as an expense for the year 2011-2012. In the instant case, A Limited approached the arbitrator before the end of the reporting period, who decided the award after the end of the reporting period, but before approval of the financial statements for issue. Accordingly, the conditions were existing at the end of the reporting date because A Limited had approached the arbitrator before the end of the reporting period, whose outcome has been confirmed by the award of the arbitrator. Therefore, it is an adjusting event. Accordingly, the measurement of the provision is required to be adjusted for the event occurring after the reporting period. As far as the recovery of the cost by A Limited from the other party is concerned, this right to recover was a contingent asset as at the end of the reporting period. As per para 35 of Ind AS 37, contingent assets are assessed continually to ensure that the developments are appropriately reflected in the financial statements. If it has become virtually certain that an inflow of economic benefits will arise, the asset and the related income are recognized in the financial statements of the period in which the change occurs. If an inflow of economic benefits has become probable, an entity discloses the contingent asset. On the basis of the above, a contingent asset should be recognized in the financial statements of the period in which the realization of asset and related income becomes virtually certain. In the instant case, the recovery of cost became certain when the arbitrator decided the award during 2012-2013. Accordingly, the recovery of cost should be recognized in the financial year 2012-2013. A company manufacturing and supplying process control equipment is entitled to duty drawback if it exceeds its turnover above a specified limit. To claim duty drawback, the company needs to file application within 15 days of meeting the specified turnover. If the application is not filed within stipulated time, the department has discretionary power of giving duty drawback credit. For the year 2011-2012, the company has exceeded the specified limit of turnover by the end of the reporting period, but the application for duty drawback is filed on April 20th, 2012, which is after the stipulated time of 15 days of meeting the turnover condition. Duty drawback has been credited by the department on June 28, 2012, and financial statements have been approved by the board of directors of the company on July 26, 2012. Whether the duty drawback credit should be treated as an adjusting event. In the instant case, the condition of exceeding the specified turnover was met at the end of the reporting period, and the company was entitled for duty drawback, but the application for the same has been filed after the stipulated time. Therefore, credit of duty drawback is discretionary in the hands of the department. Accordingly, the duty drawback is a contingent asset at the end of the reporting period, which may be realized if the department credits the same. As per para 35 of Ind AS 37, contingent assets are assessed continually to ensure that the developments are appropriately reflected in the financial statements. If it has become virtually certain that an inflow of economic benefits will arise, the asset and the related income are recognized in the financial statements of the period in which the change occurs. If an inflow of economic benefits has become probable, an entity discloses the contingent asset. In accordance with the above, the duty drawback credit, which was contingent asset for financial year 2011-2012, should be recognized as an asset, and related income should be recognized in the reporting period in which change occurs. That is, in the period in which realization becomes virtually certain, which is financial year 2012-2013. Next, XYZ Limited sells goods to its customer with the promise to give discount of 5% on list price of the goods provided that the payments are received from the customer within 15 days. XYZ Limited sold goods of 5 lakhs to ABC Limited between 17th March and 31st March 2012. ABC Limited paid the dues by 15th April 2012. With respect to sales made between 17th March 2012 and 31st March 2012. Financial statements were approved for issue by Board of Directors on 31st May 2012. State whether discount will be adjusted from the sales at the end of the reporting period. As per Ind AS 115, if the consideration promised in a contract includes a variable amount, an entity shall estimate the amount of consideration to which the entity will be entitled in exchange for transferring the promised goods or services to a customer. In the instant case, the condition that sales have been made exists at the end of the reporting period, and the receipt of payment within 15 days time after the end of the reporting period and before the approval of financial statements confirm that the discount is to be provided on those sales. Therefore, it is an adjusting event. Accordingly, XYZ Limited should adjust the sales made to ABC Limited with respect to the discount of 5% on the list price of goods. Next, whether the fraud related to 2011-2012 discovered after the end of reporting period but before the date of approval of the financial statements for 2013-14 is an adjusting event. In the instant case, the fraud is discovered after the end of reporting period of 2013-14, which related to financial year 2011-12. Since the fraud had taken place before the end of the reporting period, the condition was existing, which has been confirmed by the detection of the same after the end of the reporting period, but before the approval of financial statements. Therefore, it is an adjusting event. Moreover, Ind AS 10 in paragraph 9 specifically provides that the discovery of fraud or error after the end of the reporting period that shows that financial statements are incorrect is an adjusting event. Such a discovery of fraud should be accounted for in accordance with Ind AS 8 if it meets the definition of prior period error. Next, X Limited was having investment in form of equity shares in another company as at the end of the reporting period, that is 31st March 2012. After the end of the reporting period, but before the approval of financial statements, it has been found that the value of investment was fraudulently inflated by committing a computation error. Whether such event should be adjusted in the financial statements for the year 2011-2012. Since it has been detected that the fraud has been made by committing an intentional error, and as a result of the same financial statements present and as a result of the same the financial statements present an incorrect picture, which has been detected after the end of reporting period but before the approval of financial statements, the same is an adjusting event. Accordingly, the value of investments in the financial statements should be adjusted for the fraudulent error in computation of value of investments. Next, ABC Limited received a demand notice on 15th June 2002 for an additional amount of 28 lakh from the Excise Department on account of higher excise duty levied by Excise Department compared to the rate at which the company was creating provision and depositing the same in respect of transactions related to the financial year 2001-2002. The financial statements for the year 2001-2002 are approved on 10th August 2002. In July 2002, the company has appealed against the demand of 28 lakh, and the company has expected that the demand would be settled at 15 lakh only. Show how the above event will have a bearing on the financial statements for the year 2001-2002, whether these events are adjusting or non-adjusting events, and explain the treatment accordingly. Ind AS 10 defines events after the reporting period as follows. Events after the reporting period are those events favorable and unfavorable that occur between the end of the reporting period and the date when financial statements are approved by the board of directors in case of a company and by the corresponding approving authority in case of any other entity for issue. Two types of events can be identified. Those that provide evidence of conditions that existed at the end of the reporting period, which are adjusting events after the reporting period, and those that are indicative of conditions that arose after the reporting period, non-adjusting events after the reporting period. In the instant case, the demand notice has been received on 15th June 2002, which is between the end of the reporting period and the date of approval of financial statements. Therefore, it is an event after the reporting period. This demand for additional amount has been raised because of higher rate of excise duty levied by the excise department in respect of goods already manufactured during the reporting period. Accordingly, condition exists on 31st March 2002 as the goods have been manufactured during the reporting period on which additional excise duty has been levied, and this event has been confirmed by the receipt of demand notice. Therefore, it is an adjusting event. In accordance with principles of Ind AS 37, the company should make a provision in the financial statements for the year 2001-2002 at the best estimate of the expenditure to be incurred, which is 15 lakh. XYZ Limited was formed to secure the tenders floated by a telecom company for publication of telephone directories. It bagged the tender for publishing directories for Pune Circle for 5 years. It has made a profit in 2013-14, 14-15, 15-16, 16-17. It bid in tenders for publication of directories for other circles, Nagpur, Nashik, Mumbai, Hyderabad. But as per the results declared on 23rd April 2017, the company failed to bag any of these. Its only activity till date is publication of Pune directory. The contract of publication of directories for Pune will expire on 31st December 2017. The financial statements for financial year 2016-17 have been approved by the Board of Directors on July 10, 2017. Whether it is appropriate to prepare financial statements on going concern basis. With regard to going concern basis to be followed for preparation of financial statements, Ind AS 10 provides as follows. An entity shall not prepare its financial statements on a going concern basis if management determines after the reporting period either that it intends to liquidate the entity or to cease trading or that it has no realistic alternative but to do so. Deterioration in operating results and financial position after reporting period may indicate a need to consider whether the going concern assumption is still appropriate. If the going concern assumption is no longer appropriate, the effect is so pervasive that this standard requires a fundamental change in the basis of accounting rather than adjustment to the amounts recognized within the original basis of accounting. In accordance with the above, an entity needs to change the basis of accounting if the effect of deterioration in operating results and financial position is so pervasive that management determines after reporting period either that it intends to liquidate the entity or to cease trading or that it has no realistic alternative to do so. in the instant case, since contract is expiring on 31st December 2017 and it is confirmed that on 23rd April 2017, that is after the end of reporting period and before the approval of financial statements, that no further contract is secured, implies that the entity's operations are expected to come to an end. Accordingly, if entity's operations are expected to come to an end, the entity needs to make judgment as to whether it has any realistic possibility to continue or not. In case the entity determines that it has no realistic alternative of continuing the business, preparation of financial statements for 2016-17 and thereafter ongoing concern basis may not be appropriate. Next, ABC Limited received a demand notice on 15th June on additional amount of 28 lakh. This is the same question. Discuss the reasons whether these events are in nature of adjusting or non-adjusting and the treatment needed in light of accounting standard Ind AS10. Moon Limited won an arbitration award on 25th April 2019 for 1 crore. From the arbitration proceeding, it was evident that the company is most likely to win the arbitration award. The directors approved the financial statements for the year ended 31/3/2019 on 1st May 2019. The management did not consider the effect of the above transaction in the financial year 2018-19 as it was favorable to the company and the award came after the end of the financial year. This is an adjusting event. It is an adjusting event as it is the settlement after the reporting period of a court case that confirms that the entity had a present obligation at the end of the reporting period. Even though winning of award is favorable to the company, it should be accounted in the books as a receivable since it is an adjusting event. Zoom Limited has a trading business of mobile telephones. The company has purchased 1,000 mobile phones at 5,000 each on 15th March 2019. The manufacturers of the phone had announced the release of new version on 1st March 2019, but had not announced the price. Zoom Limited has valued inventory cost of 5,000 each at the year ended 31st March 2019. Due to arrival of new advanced version of mobile phones on 8th April 2019, the selling prices of the mobile stocks remaining with the company was dropped at 4,000 rupees each. The financial statements of the company valued mobile phones at 5,000 each and not at the value of 4,000 less expenses on sales, as the price reduction in selling price was affected after 31st March 2019. This is an adjusting event. The sale of inventories after the reporting period may give evidence about the net realizable value at the end of the reporting period. Hence, it is an adjusting event. As per Ind AS 10, Zoom Limited should value its inventory at 40 lakh. Hence, appropriate provision must be made for 10 lakh. There is an old due from debtor amounting to 15 lakh against whom insolvency proceedings were instituted prior to the financial year ending 31st March 2019. The debtor was declared insolvent on 15th April 2019. This is an adjusting event. As per Ind AS 10, the receipt of information after the reporting period indicating that an asset was impaired at the end of the reporting period or that the amount of a previously recognized impairment loss for the asset needs to be adjusted. The bankruptcy of a customer that occurs after the reporting period usually confirms that the customer was credit impaired at the end of the reporting period. Next, assume that subsequent to the year end and before the financial statements are approved, company's management announces that it will restructure the operation of the company. Management plans to make significant redundancies and close a few divisions of the company's business. However, there is no formal plan yet. Should the management recognize a provision in the books? If the company decides subsequent to end of the accounting year to restructure its operations, this is a non-adjusting event. Announcing or commencing the implementation of a major restructuring after the reporting period is a non-adjusting event as per Ind AS 10. Though this is a non-adjusting event occurred after the reporting period, yet it would result in disclosure of the event in financial statements if restructuring is material. This would not require provision since As per Ind AS 37, decision to restructure was not taken before or on the reporting date. Hence, it does not give rise to the constructive obligation at the end of the reporting period to create the provision. Next, discuss the following situations as per Ind AS 10. The financial statements of a company for the year 2021-2022 are approved by the management and were sent on 5th June 2022 for review and approval to its supervisory board, that is Board of Directors. The supervisory board approves the financial statements on 26th June 2022. The financial statements are then made available to the shareholders on 4th July 2022. The financial statements are approved by the shareholders in the annual general meeting on 18th August 2022 and then filed with the Ministry of Corporate Affairs on 19th August 2022. Determine and discuss the date on which financial statements were approved. As per Ind AS 10, in case of a company, the financial statements will be treated as approved when Board of Directors approve the same. Hence, in the given case, the financial statements are approved for issue on 26th June 2022, which is the date of approval by the Board of Directors for issue of financial statements to the shareholders. A company is in litigation with the Income Tax Department with respect to allowability of certain exemptions for financial year 2018-2019. No provision of tax has been made for disallowances of exemptions as the company was under bona fide belief based on a legal opinion that it will succeed the litigation. On 21st April 2023, the Honorable Supreme Court rejected the company's claim. The order is received on 30th April 2023. The financial statements for the year 22-23 of the company are yet to be approved. The earlier year's financial statement stands approved. Advise in financial statements of which financial year the impact of order of Honorable Supreme Court should be recognized. An event after the reporting period is an adjusting event if it provides evidence of a condition existing at the end of the reporting period. Court order received after the reporting period but before the financial statements were approved provides evidence of liability existing at the end of the reporting period. Therefore, the end event will be considered an adjusting event and accordingly the amount will be adjusted in the financial statements for the financial year 22-23. Z Limited, while preparing made financial statements on 31st March 2023 made a provision for doubtful debts at 6% on accounts receivables. In the last week of January 2023, a debtor for 3 lakh had suffered heavy losses due to fire. The loss was not covered by any insurance policy. Z Limited considered the event of fire made a provision of 60% of the amount receivables from that debtor apart from the general provision of 6% on remaining debtors. The same debtor was declared insolvent on 10th April 2023. The financial statements have not yet been approved. You are required to suggest whether the company should provide for full loss arising out of the insolvency of the debtor in the financial statements for the year ended 31st March 2023. In the instant case, the fire took place in January 2023, which is before the end of reporting period. Therefore, the condition existed at the end of the reporting period, though the debtor is declared insolvent after the reporting period. Accordingly, full provision for bad debt amounting to rupees 3 lakh should be made to cover the loss arising due to the bankruptcy of the debtor in the financial statements for the year ended 31st March 2023. D Limited acquired equity shares of another company on 1st March 2023 at a cost of rupees 28 lakh. The fair market value of these shares on 31st March 2023 were 35 lakh and the company measured it at 35 lakh. Assume that it is classified as equity OCI as per Ind AS 109 and change in fair value is transferred to fair value fluctuation reserve. Due to market conditions subsequent to the reporting date, the value of investments drastically came down to 20 lakhs. The financial statements have not yet been approved. You are required to suggest whether D Limited should have investments at 35 lakh or 20 lakh as at 31st March 2023. A decline in fair value of investments between the end of reporting period and the date when the financial statements are approved for issue is a non-adjusting event. The decline in fair value does not normally relate to the condition of investments at the end of the reporting period, but it reflects the circumstances that have arisen subsequently. Therefore, D Limited should value the investments at 35 lakh as on 31st March 2023. Tanmay Limited was in negotiation with Varun Limited from 1st December 2022 to acquire land for 5 crores. The negotiations were concluded in the first week of April 2023. The transaction was completed by last week of April, and in which financial year the purchase of land should be recognized. As per Ind AS 10, an entity should adjust the financial statements for events that occurred after the reporting period but before the financial statements are approved for issue, if those events provide evidence of conditions that existed at the end of the reporting period. In this case, negotiations continued with Varun Limited to acquire land from 1st December till first week of April 2023. Since on the reporting date, the condition was only on proposal state and transaction was completed on first week of April, the event will be considered as a non-adjusting event as per Ind AS 10. Purchase of land should be recognized in the financial year 23-24. However, the same may be disclosed in notes to accounts for due information to the users of financial statements. These are all the questions.